You can be right 70% of the time and still lose money, and you can be wrong 70% of the time and still get rich. If that sounds backwards, stay with me, because by the end of this, you'll never look at your win rate the same way again. Quick note before we start. This is educational commentary, not personalized financial advice. I'm going to teach you a way of thinking, not tell you what to buy. The number almost every retail trader obsesses over is win rate. What percentage of my trades made money? It feels like the scoreboard. It isn't. Win rate is one input. The number that actually decides whether you survive is expected value. Expected value, or EV, is the average outcome of a bet if you could repeat it forever. It combines how often you win with how much you win and how much you lose. Miss any one of those and you're flying blind. Let's build it from scratch with a coin. A fair coin lands heads half the time. Suppose I pay you $11 when it's heads and you pay me $10 when it's tails. Your win rate is exactly 50%. Coin flips don't care about your feelings, but your expected value per flip is 1/2 times plus 11 plus 1/2 times minus 10. That's $5.50 minus $5, which is positive 50 cents. Same win rate as a coin, but you make money on every single flip on average. Now flip the payouts. You win 10 when it's heads, you lose 11 when it's tails. Still a 50% win rate, identical hit rate. But now your EV is minus 50 cents a flip, same odds of being right, opposite destiny. This is the whole game in one example. Win rate told you nothing. The size of the wins versus the size of the losses told you everything. Let's push harder because this is where it gets counterintuitive. Roll a single die. You only win on a 6. That's a win rate of about 17%. Sounds terrible. 5 out of 6 times you lose. But say you lose $1 on rolls of 1 through 5 and you win $10 on a 6. Your EV is 5/6 times minus 1 plus 1/6 times plus 10. That's minus 83 cents plus $1.67. Positive 84 cents per roll. You lose most of the time and you get richer. This is exactly why a trend-following trader can lose on 2/3 of their trades and still crush it. They take lots of small, controlled losses and occasionally catch a move that pays 10 or 20 times the risk. Their win rate is ugly. Their EV is beautiful. Meanwhile, the trader who wins 9 times out of 10 by selling naked options and taking tiny premiums looks like a genius, right up until one move wipes out a year of gains. High win rate, negative EV, hidden until the tail shows up. So here's the formula, plain English. Expected value equals your probability of winning times your average win, minus your probability of losing times your average loss. 4 numbers, not one. Anytime someone brags about a win rate and leaves out the average win and average loss, they've shown you a quarter of the picture and asked you to bet on the whole thing. Now let's connect this to how markets actually price risk. When you buy a short-dated option, the market is quoting you an implied probability and an implied payout at the same time. The premium is essentially the market's estimate of the bet's fair value plus a little edge for the seller. Your job as a trader is not to guess direction. Your job is to find the spots where your estimate of the 4 numbers differs from the market's, and to only act when that difference is in your favor. That gap is your edge. No gap, no trade. Here's the part that separates people who last from people who don't. Positive expected value is necessary but not sufficient. You also have to survive long enough for the average to show up. A bet can be positive EV and still ruin you if you size it too big and hit a losing streak. Flip our winning coin, the plus 50 cents one, but bet your entire account each time. One bad run and you're at 0, and 0 has no comeback. The math was right. The sizing killed you. This is why disciplined traders risk a small, fixed fraction per trade, often something like 1/2 to 2% of the account. Not because it's a magic number, but because it keeps any single loss survivable so the positive expectancy has room to compound. Small size isn't timidity. It's the price of staying in the game long enough for your edge to pay you. The market rewards the patient repetition of good bets, not the size of any one bet. So what does a disciplined trader actually do with all this? First, before entering, they write down the 4 numbers: rough probability, target win, defined loss. If they can't estimate them, that's a signal the trade is a guess, not a position. Second, they demand positive expected value, not comfort. They'll take the ugly 17% win rate if the payout justifies it. Third, they size so that 10 losses in a row is annoying, not fatal. Fourth, they judge themselves on process over any single result, because in the short run, even a great bet loses plenty. And here's the mindset shift. Stop asking, was I right? Start asking, was that a good bet? Being right is an outcome. Making a positive EV bet sized correctly is a decision. You control the decision, you don't control the outcome. Over hundreds of trades, good decisions and bad luck converge toward your true edge. Bad decisions and good luck do too, and that's how the lucky eventually give it all back. If this way of thinking is useful to you, subscribe. This channel is about signal, not hype, and everything here is a framework for your own decisions, never a set of picks. Run your own numbers. Estimate the probability, the win, the loss. If the expected value isn't there, the trade isn't there, no matter how confident you feel. That confidence is the most expensive number of all, and it never shows up in the math.